if we go, let's see, to the next one. Wonderful. So this is the website for the T20. And so as I was mentioning, I'm a member of the T20. It's part of the larger G20. And we advise the G20 leaders on pressing global challenges and help to make recommendations every year. So last year, the T20 was under the Japan presidency. And so I served under that one. And then this year, it's under Saudi Arabia. And so we've been working this year. In fact, this is our big month to pull everything together and to launch the key recommendations. And so if we go to the next slide, for those of you that might be interested, if on the next slide, you can see some of the key task forces, and there are 11. And so the key task force that I'm on is actually TF6, which is the economy, employment, and education in the digital age. And if we go to the next slide. So you can see here a little bit of a description of this committee, but I wanted to talk about it because a lot of the work that I've been fortunate to do through this committee has set the stage for a lot of the research that I'm currently doing, especially related to financial and digital inclusion and in relation to a lot of the sustainable development goals and poverty in particular. And so this committee, we spend a lot of time looking at, especially this year with COVID, how the digital transformation is having clear impacts on the economy, but primarily employment and education. And we've looked at it from a number of different angles. And the focus this year that I've spent a lot of time on is the emphasis on digital and financial inclusion for vulnerable populations. And so if we go to the next slide. So the next slide. Yes, so you can see these are two briefs. They are not in their fancy form yet with their beautiful templates, but this month, next month, they're doing the final touches. But I just wanted to kind of give you an idea of some of the things that we work on, because I know that the center there spends a lot of time looking at issues such as this from a policy perspective and looking at those links between research and policy. And so one of the topics that we've been looking at is a human development approach to measuring and improving the digital livelihoods of vulnerable populations. And so we're looking here at making recommendations about how in the bigger picture, as researchers, we should start to try to consistently measure human development, but by including this new digital component of our livelihoods into the traditional models and measurements of such measurements as HDI, Human Development Index. And then in the second panel here, you will see that there is another one we've worked on, rebuilding the livelihoods of forcibly displaced populations using digital financial inclusion. And both of these you will see are with Josephine Kashana, who's actually, I think, listening to the seminar right now. She's at St. Joseph University of Beirut in Lebanon. But we've worked together on this last year and this year on topics such as this. And we've used the work that we've done through the T20 to carry over into a lot of research that we do so that we can have practical more practical implications for the research and hopefully can help to support the work that the T20 and also a lot of NGOs, government agencies, and organizations, the efforts that they're trying to do so that we can lend support to them in the type of research we're doing and the practical applications. So if we go to the next slide. I think the next slide is just a picture of one of the models that we had been working on. Yes. So just to give you an idea in your mind, this was related to the first policy brief, a human development approach to digital livelihood. And so the kind of work that we're thinking about is taking some of these traditional kind of models and thinking about the skills that people need, those traditional ones, but now adding in what is the digital component that we need to this traditional model in terms of access to even the digital infrastructure, and then the digital skills, the ability not only to use the devices, but to actually apply them in a number of different settings. And then how that then carries over in a number of different ways through to telework, digital finance, digital security, and everything such as that. So if we go to the next slide, I just wanted to give you this background because it helps to give you some context for where I'm coming at from a researcher as I talk about this particular study. This is a study where Josephine and we have another colleague here at my institution at University of Illinois Urbana-Champaign. His name's Andrew Greenlee. And we had been working with some interesting, unique data to look at the impacts of financial and digital inclusion on poverty. And what I want to do today is just specifically talk about that study and the results. And then at the end, I'm going to kind of link it back to this bigger picture and help you guys to see how this type of research can be very helpful in providing insight to what's happening at the, out in the real world, in the grassroots level. So this is the Sustainable Development Goals. There's 17 of them. In the work that I do at the international front, I think there's a pretty common consensus now that financial and digital inclusion really is needed for practically all of these to happen. And so there's always some sort of undercurrent as we talk about these different sustainable development goals and how to achieve them. There's always some sort of component that's related to financial inclusion and now digital financial inclusion. And the key one that gets a lot of attention in this arena is the first one, the poverty one. So if we go to the next slide. Yes. So under this broader umbrella of the UN 2030 agenda, we do see that financial and digital inclusion strategies are powerful tools for trying to help us to achieve these goals. If we look at just now to date where we're at, if any of you are doing work in this space, or I know several of you may be students interested in doing research in this space, there is the very famous data set, the World Bank's data set, the Global Findex. They have collected data in 2011, 14, and 17. It's one of the most commonly used data sets in this space. And looking at the numbers from this and other maybe more country-specific data sets, what we know to date is that there has been a lot of progress that is made in getting people access to bank accounts and other financial and digital services for the poor. But if we go to the next slide. So while this progress has been made, we still know that we have a lot of work to be done. World Bank estimates 1.7 billion still lack an account at a bank or mobile money provider. This is from the 2017 data. And on top of that, and with all of you being in India, you will appreciate this next comment, which is that account access doesn't necessarily imply account usage. And we know that 1/5 of all global accounts still remain inactive. And I bring up the case of India, not just because all of you are there, but in 2014, when PMDY was launched, so this was the big initiative under Modi to get every household in India a bank account. This was one of the real struggles, not only in getting people a bank account, but also in really fostering the usage of those accounts. And I know on the few trips I made to India, assisting a little bit with this and trying to help about how do we get people to use the accounts, that this what has been a real challenge, especially, if people don't have money to put in them. There's a lot of just empty open accounts that are costing the banks money to still maintain and operate. So we've got the access issue, but it's not just about access, it's about usage. And then the third kind of challenge and component here is that not all financial services and delivery channels are equally effective in reaching these kinds of development goals. And especially when it comes to poverty and inequality. And the groups that we have to be most concerned about, especially when we've had this COVID-19 and we've sped up this transformation to digital technologies, we have to be particularly concerned about these marginalized groups that are living in extreme poverty. And oftentimes what we're looking at on the T20 and in our research would be women, youth, elderly, minority populations, the forcibly displaced populations, those living in remote areas. So we have to think about and make sure they're not getting left behind. And so with this digitalization, oh no, you're okay. You can, that was good. You can go to that slide. You were keeping me moving. So the next slide. Yes. So I've been mentioning this digitalization of financial services, and especially with COVID, the shift. The big one that has held the most potential has been mobile money. And in Africa, the African countries that we've done research in, they have really done a great job moving in that effort. And you're going to see even with this data that they have been very progressive on that front. I think Southeast Asia, including India, which you'll see the numbers for, has struggled a lot more. And some of that is due to just infrastructure issues, whether that be on the connectivity front, but also trying to get low-cost mobile phones and devices such as that available to these marginalized populations to make this more widespread usage. So to date, this whole area is still pretty new, looking at these kind of connections between financial and digital inclusion in particular. And a lot of that is because of limited data that's been available to look at these types of relationships and make these linkages. If you improve financial and digital inclusion, which is the belief that then we can have big impact on such things as poverty outcomes. And we still really don't know a lot about that. And so in this paper and research, we really wanted to explore that issue. So if we go to the next slide. So the contributions of this study, you're going to see, I'm going to talk briefly in a moment about the data we use. It's from the 2015 Intermedia Financial Inclusion Insight Surveys. We include 7 South Asian and Sub-Saharan African countries. India is included in this data. We're going to test several definitions of both inclusion and poverty. So we do a lot of robustness checks to see if our results are going to be consistent across those different definitions. And then we keep clicking on the bullets. Yes, we're also going to control for both the ownership, so the access issues, but the usage, because I told you both of these are important. And a lot of times, if you've seen the research, they're always usually just focused on the access part of it. Like, do you own a bank account? Because that's what they care about, is getting people bank accounts. But we are very fortunate that we have data on usage. And we're going to look at multiple channels. So the emphasis also, like even with PMJDY, has been getting the bank account for all households. But we have to be careful here, especially for vulnerable populations. Is the bank account the be-all, end-all, and the only way to get people connected to financial services? And so we have a unique opportunity here to look at non-bank financial institutions and also mobile money accounts. Okay, let's go to the next slide. And another added benefit, we're going to look at geographical heterogeneities. So for the access issues here, especially the impacts for poverty, it's very important that we look at rural and urban divides and to see how it's improving those. So for those of you that might be students on this call or other researchers, and if you haven't heard about this data set, you might be particularly interested because it does include India. We use the 5th wave of this data, and this is the most recent year for the data, but you can go back to 5 years back to get other waves of it. The waves are somewhat different. It's not a panel, it is cross-sectional data, but it's very detailed and informative data. This was developed in consultation with the Financial Services for the Poor program. This is under the Bill and Melinda Gates Foundation. It's really great data. You're going to see how detailed it is in terms of tracking the adoption and usage of digital financial services, and we can look at traditional financial services, the non-bank financial institutions, and they do even add some country-specific questions to capture the differences across countries and some of the types of institutions that are available. And then the next part down at the bottom here, you see these countries, Bangladesh, India, Pakistan, and then for Africa, we've got Kenya, Nigeria, Tanzania, and Uganda. And if we talk just a little bit more about the data on the next slide. This just gives you just a little bit bigger idea about what's in here. So very detailed information on the traditional accounts, NBFIs, mobile money. It also, though, asks about, financial and digital capabilities, financial behaviors, some of the infrastructure components we can kind of get at. If people have access to good, strong network services, so there's readiness to adopt digital financial services. If they've got a national ID card and things like this. We've got some psychometrics. Psychometrics, for those of you that maybe might not be familiar with that term, this is just information on attitudes, preferences that people might have for different types of financial services and practicing certain types of financial behaviors. And we've got a bunch of socio-demographics. The survey data was collected from over 74,000 respondents from all 7 of these countries. We have to clean the data, get rid of missing values, etc. And so in the end, we've got over 66,000 observations, which is a very healthy, robust sample size. The next slide. I mentioned to you at the beginning that we do a lot of robustness checks with multiple different types of measures. And so on the poverty end, we use 3 different measures to see how financial and digital inclusion are affecting poverty. We have the extreme poverty, which is just the standard definition, below $1.25 a day. This is USD. Then we've got general poverty below 250 USD per day. And there is an added bonus question in here for us just to check with food insecurity, which is often a good predictor of poverty as well. This is a self-reported measure where households self-report whether or not they believe they have sufficient money to purchase food. And so we can look across these 3 measures. Just for those of you that might be poverty experts, so you know in this data set what methodology they used to measure who was above and below the poverty line based on these cutoffs. It's the new poverty measure that everybody's using, the Poverty Probability Index, the PPI. And now we're going to look at, on the other side, what measures we use for financial and digital inclusion. We have 2 layers here. So the first layer is the ownership and usage of the different channels. So we're going to look at the ownership and usage of traditional bank accounts, and then MBFIs, and then mobile money accounts. And then the other layer within each of those channels, we're going to look at account ownership. in this case, whether the respondent has a registered account in their name, account user, if the respondent has used the account at any time. But this is part of the problem that has happened with India. Maybe they use it the first time to get the benefit that comes with opening the account, and then maybe it just sits open. So we really also care about those that are active account users. And this data is wonderful because it allows us to look and see not only have they used the account, but have they used it within the last 90 days. And then here, we're measuring financial and digital inclusion. This slide just shows you, for those of you that are visual, it lets you see, within each of these channels, this is what we're looking at. So we're going to be running equations for each of these and looking at the impacts at each of these different levels. Okay. Okay, I would not be an economist if I did not put up a big, huge equation here. Okay, so for those of you that are students, this is just the econometric equation. It's pretty much, initially we were running probits and then linear probability models, but we've got our poverty is a function of, it's going to be our financial and digital inclusion measure, whatever that is, if it's a traditional bank account ownership, traditional bank account user, traditional bank account active user. So we're sticking that in and running each of these while controlling for a whole host of other factors. So we've got poverty as a function of financial digital inclusion, financial digital capability. You've got to have resources just to be included. So these are things, outside things, that if you don't have those in place from an infrastructure standpoint, you're not going to be able to budge anything on the poverty. We've got our psychometrics, and we're controlling for other individual characteristics and household characteristics and country dummies. The models we're going to also estimate separately for rural and urban. And then at the very end, I'm going to show you just yet another set of robustness checks that we ran for potential endogeneity and selection bias. So I want to talk for a minute on the next slide about some of these control variables, because for those of you that are students or researchers who might be seeing this data for the first time, if we go to the next slide, there are some really interesting variables in here that make for this to be a nice one when you're looking at financial and digital inclusion issues. So in terms of financial and digital capability, we have information on people's financial literacy levels, their mobile phone proficiency, their mobile money proficiency. So how well are they able to conduct, a series of tasks on their phone or using mobile money. I mentioned about the resources needed for digital inclusion. You've got to have the right infrastructure in place for things to happen. So we do know if they've got reliable network coverage, if they're owning the mobile phone, if they've got SIM card, and there's even more in this data. In addition to that, psychometrics, we can look at their level of optimism, life satisfaction, their satisfaction with their financial situation, how confident are they about their future financial security, and there's a host of measures there. And then we've got pretty standard demographics. And you can see those here on the slide, those that you would think, that you control for in any model. We go to the next slide. So the next slide, yes. This one is just a big picture overview of macro variables, so you can kind of see some of the differences. We've got the South Asian countries in the first three columns. So you can see India is in the second column, and then we've got the Sub-Saharan Africa countries. But just we pulled some macro measures from a number of different data sources just to give the big picture. So we've got poverty and inequality measures, some macro financial infrastructure measures, technology infrastructure, financial inclusion indicators, capability. But what you can kind of see here, and especially if we pick out India for a minute, you can kind of see where India is at within these 7 countries in terms of poverty and inequality. We see that the South Asian countries are maybe doing a little bit better on that end than the Sub-Saharan Africa. In terms of financial infrastructure, you know, some of these should not be surprising because of the PMJDY movement in India. That you'll see they've got very strong the infrastructure there in terms of commercial bank branches per 1,000 adults, and in terms of the distance is quite good compared to these other countries. We can also see ATMs and things like that, which is also quite good. This is not surprising. We see mobile phone subscriptions, internet usage, which is stronger than some of these others as well. And you're going to see some of these themes when we look at the actual data that India also has strong account access and in terms of ownership and usage. So if we go to the next slide. The next slide is going to show us the micro level data using the FII data. So on the next slide. Yes, I actually circled a few numbers, again, just to kind of quickly give you an idea of where some of the biggest differences between South Asia and Africa are. And the differences with South Asia really are being driven primarily by the numbers for India, because that sample size is so large. But poverty-wise, we see that with Africa, the African countries were more likely dealing with extreme poverty, and South Asia is more heavy. Oh, we go back. I'm still not done. We're gonna go back to the previous. Yes. So with South Asia, we're dealing with more general poverty. The account ownership, you can see clearly that South Asia is more weighted towards the traditional bank account ownership, whereas Africa, we've got a higher percentage with MBFIs and MMAs. This is not surprising because Africa has had the big push towards more mobile money, and they've done that very successfully with digital financial services. Account ownership, we see, again, not surprising, the movement for both account user and active account users around mobile money, again, for Africa, and the traditional banks with South Asia, but again, that's being driven by the big push in India for bank accounts. And so now if we go to the next slide. We go to the next slide. You know, I think we can skip this because I think I already highlighted these kind of key descriptive findings. So for the sake of time, I think we'll move on to the next one. So this next one just helps us to see a good connection for the research question is, what's the impact of financial and digital inclusion on poverty outcomes? This descriptive table highlights that what we start to see just descriptively is a negative kind of relationship, that as you get more account ownership and active account users, you see lower rates of poverty. And so here, in terms, we're comparing the extreme poverty, and they're not in extreme poverty, general poverty not in general poverty, and food insecurity not food insecure. But you can start to see that the basic idea here is that when you look at those that are in poverty, they have lower rates of ownership, lower levels of account usage in all of these cases. So what we hope now, and where we're going with all of this, is descriptive statistics don't necessarily, you know, indicate that is exactly the relationship, that we need to use our regression analysis to hold, you know, as many factors constant as we possibly can to see that if in that case, do we still tend to get this trend, and is it statistically significant? So we're going to move on to the next slide. Yes. And then this is just the conclusion that I just said to you. So we're going to do next step, examine more rigorously the relationship. So let's go on to the next slide. What we're going to do next, I'm going to show you the regression findings. So we ran probit models and we ran linear probability models just to check again for consistency. And this is our baseline model. So our baseline model was looking at the impacts of bank account ownership on poverty. And what we see here is very consistently, you can see that across the board for all of these, if you increase bank account ownership, it's decreasing our poverty measures. Another interesting point to make here, because of this emphasis right now on the digital end, we had these measures for financial and digital capability. We had indices for financial literacy and an index for digital literacy in terms of being able to operate your mobile phone and use mobile money. And we see here that there is also a negative relationship. So the higher your digital literacy level, we also see strong and significant reductions in poverty. Let's go to the next slide. So this slide shows all the different the results from all the different regressions. If you remember that visual chart that I showed you a little bit ago that showed all the with the bubbles and all the different models we were going to run in terms of the channel versus within that channel ownership and account usage. This is just the summary table. Instead of presenting you every single regression result, we present the highlights here. And so the first row is just the baseline model. These are that I just showed you. And so we can also then start to look at, well, what about for NBFI accounts? If you're using an NBFI account, how does that affect poverty? What about using a mobile money account? How does that affect poverty? And here, for the most part, we are seeing consistent relationships, especially this consistent negative relationship for extreme poverty and general poverty. And so this part you can start to see. And I highlight more of the numbers in the extreme poverty column because we see that many more of those numbers are highly significant, and this is good. It's a good sign that basically if you're getting people access and getting them to use these financial and digital services, for those that could be the most vulnerable, the results seem to suggest that they're likely to be the most impacted by this and in a positive way. There is something that some of you might notice is that if you notice with food insecurity, this is that kind of interesting self-reported measure that we do see some positive relationships with that in table 4. And you might think about it I wrote it down. So the question is that regularly having insufficient money for food. Do you regularly have insufficient money for food? And so this could be part of what might be driving that, is that if you don't have money to put in the bank account to use it, you may not even be able to really open a bank account, and so you may not have any need for the bank account, but you do have a need for alternative financial services, which would be through NBFI and the mobile money account. So you might be more likely then to use that to get by. And so we could maybe be seeing it from that standpoint with the food insecurity measure. Okay, table 5. We're doing good here. So table 5 is going to help us to look at the results for rural and urban. And what you're going to see as soon as we go to the next slide, the punchline there, or let's see, table 5. Oh no, we already looked at table 5. Next one, next slide. Yes, here, this is the robustness check for rural and urban. And you see again, the top panel is rural, the bottom panel is urban, but there's a lot more highlighted in the top panel. And that's just because there's a lot more interesting activity going on for rural households. So we see bank account ownership really matters, and it seems to matter more than for urban households in terms of the impact on poverty levels. We also see with active account users 90 days or more, which is great because this means they're actively using it. So if you're actively using it, we do see that that's important to reducing poverty in rural areas. We don't see as consistently significant results for the urban population. But what we do see for the urban population, and we see this for the rural population too, but there is the interesting thing to note about mobile money account ownership. And on some level, these probably make sense too, because in the urban areas is where a lot of the action right now in terms of the infrastructure for MMAs to be able to work more conveniently, for people to be able to go to locations, even to pick up money and to be able to use their phones to transfer it and then to go pick it up. It maybe is not surprising that we see that one, out of all the factors, tends to be pretty consistent in having a positive impact on reducing extreme poverty levels. Okay, next slide. I think the next slide is just going to help us here to kind of summarize the punchline before we get to one more two more robustness checks. So we see in general this consistent negative relationship, which basically means as you increase financial and digital inclusion in terms of ownership and usage of accounts, we see reductions in poverty. The most consistent and significant reductions were actually for the traditional bank accounts that we saw, and especially with our baseline model. But we do see that having access to and usage of MMAs, and also still the alternative financial service outlets, such as the non-bank financial institutions, do matter and do also provide important pathways to financial inclusion and poverty reduction, even though the results are more mixed. And while she's going to the next slide, I want to emphasize that this point is really important, because I think sometimes in this space with financial inclusion, we get so hooked on, we got to get people bank accounts. We got to get people bank accounts, and this is their way out of poverty. And I think we have to really stop and think, especially as we're in this transition towards digital transformation of financial services, what does make sense, especially for these vulnerable populations. And maybe it's not always the traditional bank account, and that maybe we have to really, be careful about always kind of putting ourselves in that box from a policy standpoint, thinking that is the main goal or solution when it comes to financial inclusion as a solution for some of these sustainable development goals. And then let's see, differences are observed in the effects of financial and digital inclusion in the rural urban areas. You guys know that. And the strongest effects tended to be for those in extreme poverty in the rural areas. Okay, next slide. We ran a couple of additional robustness checks. So for those of you that might be econometricians on this call, this is where I will get into a little bit more the little bit more technical data econometric talk. So we estimated two-stage. We instrumented basically for financial and digital inclusion, because there is some concern that there may be endogeneity between the financial and digital inclusion measures and poverty. So fortunately, in this data, they have information on the time it takes to get to the nearest type of financial service, and also the distance to the nearest financial service. So we were able to use those as IVs to instrument for financial and digital inclusion, and those did not affect significantly poverty. We ran the appropriate checks, which I'll give you reference to the paper here at the end for those of you that might be interested in the checks and tests that we ran. But we did run those, and it showed that the power of the IVs were sufficiently strong to rule out the possibility of a weak IV problem. And so if you want to look at those results, they're on the next slide. We do see some impacts. We do see a little bit of difference. It's more for general poverty. So as soon as we see that slide, you'll be able to see. Yes. So, for the most part, extreme poverty, food insecurity, this is for the baseline model, just to give you a feeling. We ran it for all the models, but we tended to see the same exact thing, that extreme poverty, food insecurity, things stayed pretty consistent. I think where the difference we saw was for general poverty. And that might make sense too, because this is kind of the cusp. These are the people that are includes more of the people on the cusp between being poor and not poor. Extreme poverty, this is very, this is the extreme poverty. And so you would think that probably an endogeneity issue might not affect the results as much on that end. So for the most part, this is kind of what we would expect. And this was using time, but we also ran it using distance, and we were finding the same kind of thing. And then on the next slide, we ran one more check. So it's hard to address all of the econometric issues in any single one model for this paper, because there are a lot of issues. And one of the other issues is the selection issue. So if we go to the next slide, there is this issue, especially, so you own an account, okay? So that one is easy. But if you're going to be a user of account, that is conditional on owning an account. And oops, go back, we're not done with that slide. So if you are an active, if you're a user of an account, especially if you're an active user, it's conditional on having to own that type of account. And what we were concerned about is that we were not controlling for selection. And we did have a lot of zeros for some of these countries where they were saying they were active mobile money account users. I think that was where we were most concerned about this. So in the descriptive tables, when you look at what's the percentage for some of these countries that own a mobile money account, it's not very high. And so what that means is that when we're running these models for active account user and active account user and active account user, we're essentially maybe just running the probit on just capturing ownership again. So we just wanted to do a check and we picked out active account users because we thought if there was any place that we would see selection issues, that would be where it probably would be at, especially for active mobile money account users. So the top panel is the original results where we're not dealing with the selection. The bottom panel, what we did is we just looked at and conditionalized the data on having ever used an account. So having ever used an account, we restricted the sample to those that had a bank account, those who had an NBFI account, or those that had an MMA for each of these models, and then we reran it. And you do see some slight differences in some cases. But, even for the case of the mobile money situation, which is the one we were most concerned about, it's good to see that things are still pretty robust. So this is good. Okay, we've only got a couple more slides and we're doing good here. I want to mention a few other limitations because I brought up the issue of endogeneity, I brought up the issue of potential selection. So we've kind of tried our best to address those. But there's a few other things, that we can point out here. I think one of the lessons we've really learned, Josephine and I have learned in doing a lot of this research in this space now, is that definitions really do matter. And I think this is why we ran as many of the robustness checks as we did. I think right now, in particular, as we move forward with research, it's going to be particularly important that we more clearly define in this space, what does it mean now to be financially included, especially with digital financial services. and what is financial inclusion and what is digital financial inclusion, because when we're looking at different populations and thinking about the policy implications of research and what it means in terms of designing products and services to meet the needs and especially to help mitigate or improve sustainable development goals, we need to really think about this. And what does it also mean to be financially literate and digitally financially literate and capable? What are the skills that these populations need to be financially and digitally financially included? And Josephine and I have another paper that's actually looking at specifically financial literacy and digital financial literacy and the impacts on financial inclusion. And so that's one thing to keep in mind here, is that I think this is a time where we need to be very careful about the definitions. Oh, we're not done. And the second one, which you can't see right now, but yeah, there we go. It's lack of longitudinal data. So this was cross-sectional data. We were able to do a two-stage model with an instrumental variable to address somewhat endogeneity, but it would be really nice to have longitudinal data. In this space, it's very rare that we have the luxury in the financial inclusion space to have that, unless they're, selective samples, and then we start to question the representativeness of those. So that's another issue. Robustness checks. We did our best with endogeneity and selection, but we do have to be careful here that relationships, we're showing relationships at the end of the day. And I think there's still some questions about whether or not this is causation and what's the direction. Is it poverty to financial and digital inclusion, or is it financial and digital inclusion to poverty? And what's exactly the magnitude of these relationships? How big is the size of the effect that these are having? Okay, next slide. Implications of this research. So on this end, I think the end of the day, I've hit on some of these already. I think we've just really, as we move forward, and I know this is carried over to some of the recommendations Josephine and I have made on the T20 when we've been working on the policy briefs, that we really in this space need to think more holistically about financial inclusion now. And with COVID-19 and this speeding up that we've done of the digital transformation of the services, we have to be really careful that these gaps with some of these marginalized populations don't get bigger as we rush forward. And because of that, we do really need to think more holistically about redefining some things within this space, that it may not just be a traditional bank account now. We have to think about some of these alternative financial services such as MMAs and the role that they're playing, and new forms of digital financial services that are popping up, and the potential for them to impact sustainable development goals, especially the first one here with poverty. So next slide. I think the next slide, I think, is just emphasizing again this kind of COVID, the importance of this research right now, because I do think that there's a lot that can be learned from this, yes, and helping to bridge some of these digital divides. Next slide. So this is the paper. It's on SSRN right now. It's also on ResearchGate. So for those of you that found this interesting and you want to take a look at it, please feel free to go, and we would welcome any feedback that people have. So feel free to email myself or any of my co-authors. We would welcome that. And you can see the details, all the tables and things like that. So if we go to next slide. I think next slide is kind of, where's all this headed? So I guess to quickly say that, so that I give you guys some time just to ask me some questions if you have any, is that Josephine and I and our colleagues, we've been doing research, I mentioned, on financial and digital financial literacy. We just released another paper actually on fintech and the impact of fintech on saving, borrowing, and remittance behaviors. And that's for the, I think, 16 largest emerging economies. India's included in that. We have, interestingly enough, we have access to data from the world's first global fintech measure that measures a country's fintech environment and whether it is conducive to producing more financial inclusive results. And we found significant impacts there, including for India. We're using these kind of research also to try to have a bigger impact on global international policy with T20. There's so many. Oh, the last one, because Heba, I know, is aware of this, but if any of you have connections with the MENA region, I know Josephine and I right now are working with the UNHCR, the World Food Program, and UNICEF with data on Syrian refugees in Lebanon. And we're looking again at these kinds of factors, but we're trying now to develop a new and more comprehensive measure of multidimensional poverty to better predict future poverty, especially for highly vulnerable populations, such as refugees and other forcibly displaced populations. So those are just some of the pathways that all of this is heading. And so on the next slide, I think it's my contact information. Oh, yes. Okay, so I want to say Dhanyavad. Okay, for those of you that are there in India, I'm very grateful, very appreciative. And I guess I just want to open it up and see where Heba wants to take this now.